Chapter 4, Detecting Fraud in Financial Reporting. In this chapter, we're going to look more in depth about how financial statement fraud is committed and what we can do to hopefully try to prevent it. Now, first of all, here's a definition of fraud. Now, these are four major legal elements of fraud that need to exist before fraud can be proven. Now, these are important, and these would be very good test questions, so make sure you know these. The first one, a false representation or willful omission regarding a material fact. So, you have to have a false representation, or like it says, willful omission. So like it's done on purpose, you can say. The second one, the fraudster knew the representation was false, so there's complete knowledge here. The third one, the target, the victim, relied on this misappropriation. And then the fourth one, the victim suffered damages or incurred a loss. So all these must be present before fraud can be proven in a court of law. Here are a few definitions for us to cover. Materiality, first of all, is the measure of whether something is significant enough to change an investor's investment decision. You probably have already studied this in your auditing class, and auditors, external auditors, are concerned with materiality, but forensic investigators, forensic accountants, are not. In other words, forensic accountants are looking for anything that would be unusual, out of place, or any kind of element of fraud, no matter how small. Because if a small element of fraud is found, that could lead to a larger one. So materiality concept, that's more for external auditors, not for forensic accountants performing like a fraud investigation. Now, control risk is the risk that a material error in the balance or transaction class, like accounts, will not be prevented or detecting. This next page, we have two more types of risk. Inherent risk is a risk that an account or transaction contains material misstatements before the effects of the controls. And then the detection risk is a risk that audit procedures will not turn up a material error when it exists. So make sure you know those three types of risk and also know what materiality means. Now, external auditors, over the years, yes, they were responsible for detecting material misstatement caused by fraud. Not maybe small frauds going on within the company that might be like within the hundreds or thousands of dollars, but for a large company that's being audited that might be a multi-$100 million company or multi-billion-dollar company, a very small fraud would not be material. So these are for external auditors here. They were not worried about the small frauds. Well, I shouldn't say. They were worried about it, but if they did not detect it, then it was not considered, a lacking of their duties. Now, SAS 99 has detailed more precisely what is required to fulfill those responsibilities. And we're talking about detecting material misstatement caused by fraud. Now, auditors must specifically assess and respond to the risk of material misstatement due to fraud and must assess that risk from the perspective of the broad categories listed in SAS 99. Here are what are called the 3 M's of financial reporting fraud. The first M you can see is manipulation. So this is also the falsification or alteration of accounting records or documents. The second M, misrepresentation or intentional omission from financial statements of events, transactions, or other significant information. And the third one, the second word is the third M, misapplication, but intentional misapplication of accounting principles relating to amounts, classification, manner of presentation, or disclosure. So make sure you know these 3 M's. This is what could happen when financial statement fraud exists. It probably relates to one of these 3. A very important consideration for auditors, and forensic investigators to consider will be how management can override controls. We're talking about internal controls within the business. Internal controls are there for a reason, and we're trying to make sure that the accounting records are accurate, they don't have errors, and that there's nothing intentional going on to make the numbers, look worse or better than they're supposed to be. Now, management, though, upper management, might be able to override internal controls. And this is where you're trying to separate duties and so forth, and management might come in and try to tell a lower level employee, I want you to record a certain item a certain way. That relates to the first one, recording fictitious journal entries, especially near the end of a quarter or a year. This has happened a lot in the past. Management wants to hit those numbers. What did they estimate the quarter was going to be before it started? And at the end of the quarter, they're saying they might not get close enough to hit those. They might just just make up an entry, a journal entry, to make the numbers look good. Again, to hit those numbers. What are our earnings per share supposed to be? And they just create numbers. WorldCom did this. Towards the end of a quarter, they would just create entries with millions of dollars in the entry, and these entries were just, false. The second one, intentionally biasing assumptions and judgments. So GAAP, generally accepted accounting principles, gives you flexibility on estimating allowances and so forth, but if those are intentionally biased to make the numbers look better, that's where management is overriding controls. And also altering records and terms related to important and unusual transactions. Now, SAS 99 recommends brainstorming. So before auditors are supposed to go out on an audit, again, we're talking about external auditors, they're supposed to think about where potential fraud might exist. So they evaluate the company, the industry it's in, the kind of accounting records they have, the people who are there, and try to think about what should we look at closer. Where could we find, potential fraud? The second one talks about increased emphasis on professional skepticism. This is where the auditor needs to change maybe the thinking, the attitude, and so forth. And for example, if you've been auditing a company for several years, you might think, well, nothing has been found, nothing as to fraud has been found before, so it probably will not happen again. Well, it might happen. Fraud can happen anytime. So you need to be skeptical about going into an audit and keep your eyes open and look for fraud. Unpredictable audit test. If you audit a client year after year, that client knows which test you're going to perform. So SAS 99 recommends perform some tests that are not the typical kind of tests that we do every year. Make them unpredictable. So you might, locate something in an account you usually don't audit very closely, and there could be fraud involved. So again, perform unpredictable audit test. And the fourth one here, responding to management override of controls. You look for it. If that happens, you really have to assess what's going on. There is a larger percentage of fraud that could be possible if management has the ability and does actually override internal controls. Now, on the next slide, right here it is, okay. SAS 99. Again, skepticism, we talked about this, so here's a formal definition of it. An auditor is instructed to conduct an audit with a questioning mind that recognizes the possibility that a material misstatement due to fraud could be present, regardless of any past experience with that, that entity, and regardless of the auditor's belief about management's honesty and integrity. Now, yes, you might not have had any trouble with this audit client in the past. You feel management's honest, but still keep that skepticism. I think it helps keep your eyes open, and you won't just take someone's word for something. When you're talking to them, make sure you always back it up with some kind of documentation. Here we have the Public Company Accounting Oversight Board, the PCAOB. And this was created along with the Sarbanes-Oxley Act of 2002. It's a 5-member board. This board is empowered to set accounting standards that establish auditing, quality control, and ethical standards for accountants. Also, it is empowered to adopt or amend standards issued or recommended by private accounting industry groups, like the AICPA or the FASB, or to adopt its own standards independent of such private industry standards or recommendations. So this PCAOB has a lot of authority over the accounting profession. It was created back in 2002. Before that, the accounting profession sort of just took care of itself. But then when we had the tremendous financial statement scandals of Enron, WorldCom, Tyco, and a handful of others, they all sort of happened at once, or found out about it once. The government stepped in and said, well, no, we are going to look closer at the accounting industry, oversee it closer, and we can step in and issue standards if we want to. So this is the Public Company Accounting Oversight Board. Now, here's a different perspective about internal auditors. And of course, internal auditors are employees of the corporation, and they are there year-round auditing various aspects of the business. And they have their own set of standards. And the standards say that the internal auditor should evaluate the adequacy and effectiveness of controls. Again, this means internal controls for safeguarding assets. And also internal auditors, it says, are in a better position than external auditors to detect the symptoms of fraud and abuses, especially when they use more forensic techniques. They meaning the internal auditors. So like I said just a minute ago, the internal auditors, they are there day in and day out. They are auditing all aspects of the company year-round, and they don't just come in for like a month like the external auditors and do sampling and so forth and then leave. They are there. So they have the time, have the ability to look for fraud and find that fraud, no matter how small it is. So there's a lot of responsibility for internal auditors to find fraud in addition to the other duties that they perform. Now, when internal auditors find fraud, they are to notify management or the board of directors when the incidence of significant fraud has been established to a reasonable certainty. And also number 2 here, if the results of a fraud investigation indicate that previously undiscovered fraud materially adversely affected financial statements for 1 or more years. So you can look in the past, where the statement's incorrect because of fraud. The internal auditor should inform appropriate management and the audit committee, we'll talk about that more in just a minute, or the board of directors. Also, a written report should include all findings. That just makes sense. And number 4, a draft of the written report should be submitted to legal counsel for review. Yes, the corporation should have legal counsel involved in this, and so the internal auditor should go to legal counsel and say, here is what we have found. Here were the methods we used. Here are the documents we found. Here is what we believe happened. And so let legal counsel review this first before it goes any further. The Audit Committee. This is a subcommittee of the corporation's board of directors. And this Audit Committee oversees the organization's financial reporting and internal control process. That is their main responsibility. So they monitor the components and parts of the audit process. So external auditors report directly to the Audit Committee. Internal auditors should also. It depends on the company policy. They might go to management as well, but they really need to go to the Audit Committee. Next slide. Now, Sarbanes-Oxley of 2002, that was a huge act in the financial world, the accounting profession and financial world. There was a lot in that act that was passed to help clean things up. What this act also does, you can see I have it highlighted and underlined here, that the CEOs and CFOs of these publicly traded corporations, they must personally certify the financial statements, that they are correct and so forth, that are filed with the SEC. and and also the appropriateness of financial statements and disclosures. So now the CEOs and CFOs are personally responsible. In the past, they would say, well, maybe there was fraud involved and so forth, but I'm so far above journal entry making that's not my responsibility. So I should not be charged with anything. Now it is their responsibility. So they must certify themselves that the financial statements were prepared fairly. The board of directors. Now the board has, with all the changes in the accounting profession, they have more responsibility to oversee the financial reporting process. It always should have been there, but it's more clear now. So like the first point here says, they oversee the integrity, quality, transparency, and reliability of the financial reporting process. Number 2, they also oversee internal control. And number 3, they oversee the effectiveness and so forth of the audit functions. And again, you have the Audit Committee, which is made up of board members, but the overall board of directors themselves have this responsibility. Now enter the forensic accountant. Now forensic accountants, they are more detailed examiners, and they may be brought in when an investigation needs to take place after irregularities are detected. So something does not look right. We see that this, whatever the area is, needs to be explored in a lot more depth than an external auditor would do. So you can bring in the forensic accountants to do this. Also, they can help measure risk factors, and this is before fraud is found. So measure risk factors and create a policy that brings the forensic accountant in when certain scores are attained. So risk factors are set, policies are made, and that should say, okay, when do we need to bring in the forensic accountant for fraud investigation? That's what these policies can do. So the forensic accountant, yes, can help when there's actual investigation that needs to be performed, but also before that, they can help with risk factors and creating policies. Audit test. Now the panel audit effectiveness recommended that surprise or unpredictable elements should be incorporated into audit test. Now we're going back to the regular external audits. So maybe we should recount inventory or make unannounced visits to locations. Maybe we should interview financial, non-financial client personnel in different locations. So this is trying to get us to really adapt our audit procedures in a way that the client's not expecting, like recounts, unannounced test, new visits and so forth, to keep them guessing, so that hopefully it will help prevent fraud. That's the whole gist of this. Test, sort of mentioned this, test of accounts not normally performed annually. Test of accounts traditionally or frequently deemed as low risk. If there's an account deemed as low risk, that might be a way for a person committing fraud to hide what's going on. Because when assets are taken from the business, cash, inventory, equipment, or whatever, usually journal entries have to be made. You have to keep the accounts balanced out. So someone might find an account that's not checked or audited very much, and they could hide part of the entry in that account. So that's why it's asking this in the last part here, test of accounts traditionally or frequently deemed low risk. In the past, they were not looked at closely. We could do that now. Financial statement fraud categories and red flags. Let's see what we say here. Here are typical items that you see when financial statement fraud exists. Overstated revenues. Revenues are either just made up, created, or they're recorded too early, too much and so forth. Unreasonable, the second one, unreasonable management estimates. You might not estimate bad debt expense as high as it should be. And what does that do? It lowers the expenses, it raises the assets. Earnings problems. Masking reduced cash flow. So your cash flow might be becoming less and less, but the way you're making entries, the net income might look okay. So I think a good test is always look at net income and compare that to your cash flow from operating activities. I think that's very imperative to do. Excessive debt. It looks bad if you have excessive debt, and what happens is companies then might try to move some of the debt off the balance sheet. That's what Enron was doing. Inventory problems. Companies sometimes try to inflate inventory. So they're trying to show more inventory than they actually have, and of course that increases the assets. CPA problems. What this means is that a publicly traded company that must be audited by a CPA firm every year, it bounces around from CPA firm to CPA firm, and that's very unusual. And when you fire your CPA firm and hire another one, if it's a publicly traded company that did that, that is a big deal. That does not go unnoticed. So a company might be shopping around trying to figure out, okay, which CPA firm would go along with my estimates I've made or the way I record items. The second one, sales and expense problems. Again, your sales might not be recorded correctly. Your expenses might be too high, and you're trying to record those too low to make things look good. The third one, the big bath. This is where a company has so many problems and losses built into the account. Losses. They might just say, okay, this year, we're going to go ahead and just sort of clean everything up. We're going to write down assets, write down inventory, write down investments, increase our estimates. Just throw everything into 1 year. That's the big bath. You make one year look extremely bad, and then after that, things might look better. You don't want this to happen. These things should be taken care of as they occur year after year, and don't just throw them all into 1 year. And you can see the other three that are listed on this slide. Financial fraud detection tools, here are just a few of them. Interview the executives. You're trying to get a feel for the tone at the top. Do they want to have integrity? Does it seem like they would want to override internal controls? Okay. The second one, analytics. Get into data mining. We'll cover that in another course. But you have the software, computer programs analyzing the data of a tremendous amount of accounts, where you could do that. You could not do that yourself with the samples you would take on external audit. The third one, percentage analysis. This turns all the numbers, in the first two, all the numbers into percents. Sometimes it's much easier to find something that doesn't look quite right when you're looking at percentages as compared to the hundreds of millions or billions of dollars in the accounts. Turn it into a percent. So these relatively simple tests, like horizontal analysis, vertical analysis, these are great ways to look at the numbers, compare a couple of years together, and see if things look unusual. Ratio analysis is another good one. There are some behavioral approaches. So, not every fraud may be discovered through just looking at the accounting records. You might want to consider behavioral aspects of the employees. So in the second point here, employee attitudes, feelings, values, norms, interaction with peers. You look for I guess you could say outliers. Is there an employee who seems to be living larger, spending more money than they actually earn? And so if you see that, if the other employees see that, they might let you know. Because that has happened in the past. They're buying the new cars, the new houses, taking trips, and they're not making that much money through salary. Now, it could be explained through like an inheritance they received or whatever, but it should open your eyes, and you should look into these kind of situations. This is an example of an interview room. If you call someone in to interview them, whether they are an actual suspect or not, you need to make sure that the room is set up correctly, because you, as the forensic accountant, the interviewer, you don't want to get in trouble. So if you can see here, here's the door, here's the employee, the interviewee. You do not want to switch, let's say, the interviewer up here, the interviewee down here, and make the interviewee feel like, oh, the interviewer, this forensic accountant, is blocking my access to the door. They're forcibly keeping me here. You don't want that. You want to have the door, back behind to the side of the interviewee so they can get up anytime and walk out the door. Company policy might say, if you're an employee, you must participate in any type of investigation that we have going on. So the employee has the responsibility to come in and talk about these items, answer questions, but the employee as a person can always get up and walk out the door and choose not to participate. Now, that might cause them to lose their job, but they are an individual and they do not have to participate in this. Again, company policy might say yes. If they say no, again, they could lose their job. The main thing here is that you do not want to make the interviewee feel like they are being forcibly held in this room and being forced to answer questions. That could very well happen if the door is back behind the interviewer. Okay, so you don't want that to happen. What might happen? Any information you receive on this interview might be thrown out in court. So you don't want that to happen. So what's your room layout here? And if you're not an expert in interviewing, maybe you need to call an expert in to handle this situation. So interviews are very, very important. So if you're interviewing, here's some things you can look for and things you should do. Now, establish a sense of privacy so the employee feels like they can freely talk. No locks or physical impediments. We just talked about that. You cannot make the person feel like they are locked in the room or cannot leave when they want to. As a person, they can. As an employee, they're supposed to stay there. Okay. The other ones, this is someone's hints. Plain color of the room. I don't know. Lighting should be good. Yeah, that makes sense. No distractions, telephones, cell phones, beepers, or anything. Chairs, keep your distance. Same level chairs. Audio or video, record the process. Skipping a couple there. That's very important. You want to make sure that the person later on cannot say, I did not say that. If you have it on video or audio, then there's your proof. Depending on, if it's a female being interviewed, another female should be present along with the interviewer. And this should be done not at the suspect's home or office. It should be done at the employer's place of work. When you're interviewing someone, you need to tell them about the Upjohn warning. What this means is that, and this is usually when an attorney is there, the attorney should tell the employee that I represent the employer. I do not represent you, the employee. That needs to be very, very clear, because if there's an attorney present, the employee may think, oh, this person is representing me. That person will protect me. Anything I say is between the attorney and me. No. The attorney here, if it's the corporate attorney, they represent the corporation, not the employee. This needs to be very, very clear to the employee. And like the last item here, the interview notes should state that the Upjohn warning was given. Of course, if you are recording the interview, you'll have it on tape. All right, so that's quite a bit in this chapter. This is what we look for when financial statement fraud might exist, when it does exist, when we try to find it.